When we design a portfolio, we look to diversify, avoid stock picking and market timing, and take into consideration the four economic environments. The basic institutional portfolio is an excellent starting point. It is made up of just two simple indexes. It's 60% invested in the S&P 500, a popular measure of domestic stocks, and 40% invested in the Barclays U.S. Bond Index, a popular measure of the U.S. bond market. Over the past 40 years, it's delivered a return of more than 9% per year. And I'm very confident in saying this very simple portfolio has outperformed the vast majority of investors, amateur and professional. Now, even though I believe this to be an excellent portfolio that serves investors well, there are three things that we can do to enhance returns and lower the risk of the portfolio. The first thing we can do is to shorten the average maturity of the bond portfolio to reduce the risk or volatility of the portfolio. And academic evidence shows that short and intermediate term bonds deliver essentially the same return as longer term bonds, but with lower risk. Second, history shows that by introducing small cap and value stocks, we can increase returns over the long term. For instance, in this recent 20-year period, the S&P 500 averaged just under 8% per year. And when we compare this performance to a portfolio that incrementally adds small cap and value stocks, we see the return rises dramatically. For instance, a portfolio invested in 50% S&P 500 and 50% small cap and value stocks delivered a return near 9.5%. A portfolio of all small cap and value stocks returned better than 12% annually. Now, certainly, we can't guarantee this approach will continue to deliver higher returns, but the long-term evidence shows this approach has enhanced returns. Third, properly introducing international stocks into the portfolio has also demonstrated an ability to increase returns with little or no increased risk. These three steps, shorten bond maturities, introduce small cap and value stocks, and include international holdings, are the meaningful and productive steps we take for our clients. After your portfolio is designed, the market is going to test you. Again, in 2008, when the markets dropped dramatically, most investors wanted to sell their stocks and run for the hills. But rebalancing to maintaining our target asset allocation is absolutely critical to long-term success and to getting that extra return. And the market, it tells us exactly what to do. Just look at 2008. Stocks sold off, bonds did well. And let's say we had a 60% equity and 40% bond portfolio in late 2008. Stocks declined dramatically over a terrifying few months, and suddenly the 60% equity portion was worth significantly less. The last thing most investors wanted to do was to buy more stocks, but that is exactly what the market was telling investors to do. And this is a critical point. Maintain your asset allocation.